There we go. I got a
Okay,
note.
here we go. All right. All right. Good morning. Welcome to the Bob Unger Show. We have here really one of the brightest minds in the country in terms of the financial situation and the economic situation. But then again, to say he's one of the brightest minds in the
That's
country.
a low bar.
It's a very low bar.
You could step over that one.
It's a left-handed compliment.
Yeah.
Because the ignorance out there is just beyond the human imagination. If I wanted to make a movie about it, it would be rejected offhand because the directors would say, "Are you kidding? That nobody would ever believe this. It's impossible."
Exactly.
And David Haggith has started out when I got to know about him. I saw his blog, which was called the Great Recession blog, correct?
Right.
And then tell us about how it morphed.
Well, I decided to go with a Substack uh, host for my writing and my site because it seemed to be working well for a lot of people. It's more automated. So I moved over to there and created my own publishing site there called thedailydoom.com. So it's basically the same writing I was doing, but a big difference I put is now I every week they track all the headlines, and for subscribers, they can get all the headlines that I think are the most important for tracking collapse that's happening right now, along with a daily editorial. Now, even free subscribers get the daily editorial. And then for my paid subscribers, I also write on the weekend what I call a deeper dive, which is where I go into my deeper economic analysis. And that brings me back to the low bar you were just talking about, because just before we got together here, I was writing about the Fed, and I wrote, I mean, who could not see that their continuance of massive stimulus when inflation was already rising, we're talking about in the transitory days, was not going to allow inflation to be transitory? How do you miss that call when it is precisely your business and duty to know more about it and do more to prevent it than anyone in the world? This was a monumental failure on the Fed's part to miss something so blatantly obvious as it was forming. So talk about a low bar. Here it is. It's their area that they're supposed to, have more expertise in than anything. And they were calling inflation, saying it's going to be transitory. And other people could look at it and say, it's happening. How is it going to be transitory when you guys are still creating massive amounts of money while it's starting? I mean, it's just beyond belief that they kept pumping the money out when inflation was just starting to go up. That would have been a sensible point for anybody to say, well, let's at least stop the money pumping, right? Even if we don't go to tightening, let's stop accelerating this.
Well, when it comes to bonds, I find in conversations with people, this is the area in which the American people in general are the most ignorant, which is once again uh, tough to exceed. But let's start from the beginning and let's talk about very simply an economics 101 class on what a bond is, what determines the price of a bond, what determines the interest rate on the bond, and why it is that interest rates, regardless of the Fed, go up and down depending on the need for government borrowing and our deficits and our outrageous drunken sailor spending. So let's try to start at a very basic level and build from there.
Okay, good idea, because I find people's eyes gloss over as soon as you start talking about bonds. And one publisher who publishes a lot of my articles said, I got to do less of the bond stuff because I know my audience just, their eyes glaze when bonds come up. But it really is the most important market to understand right now, because it really is what's driving everything. The fall of stocks, the crash of the housing market, it's all driven by interest rates that are set by bonds. Bonds affect all interest rates. The short-term treasury bills and notes affect shorter term interest rates. The long-term bonds, like the 20-year, the 30-year, the 10-year, those affect long-term rates. Particularly the 10-year is very influential on things like mortgage rates. A lot of rates are pegged to what those bonds interest rates are. So one of the things I said going back before this inflation hit, was that we were not going to, normally, as you go into a recession, you see a thing where it's called the inversion of the yield curve. And to keep eyes from glazing over, it just means bond yields flip and look the opposite of the way they ought to in terms of how they project out over, longer duration bonds. And
In other words, what you're saying is that when you lend somebody money and they don't have to pay you back in 20 or 30 years, normally you should have to get a higher interest rate for that loan, because the longer it goes, the more you might have a chance that that person goes bankrupt and doesn't pay you. Whereas if you lend some money short term, the interest rate that you charge should be less, because it's a shorter time span where they may go bankrupt and not pay you back. Correct?
exactly. And then when that inverts, it just flips that on the head to where people are actually asking for less interest in the long term than they are in the short term. And that's because they're expecting some serious troubles in the short term that could cause problems. And they figure a longer term bond, it's going to get through all of that, and then it'll be fine in the end. So when that flips upside down, it's a strong indicator that economic problems are coming, recession's coming. And I was constantly saying in my writings, you can expect this yield curve to be late to arrive to the game. It's not going to flip ahead of recession. It's going to flip when we're already in recession. And I started saying that back in at least 2021, as we just saw hints of, inflation starting to build. And, not even in CPI, but when we were seeing it in producer prices, their prices going up, which are going to come down the pipeline. So I said the reason it's going to be late to the game is because the Fed is buying hundreds of billions in bonds, and they're totally distorting the bond market. They are effectively controlling what that yield curve is going to do. They can decide how many bonds they want to buy at the short end and how many bonds they want to buy at the long end. And their demand for the government bonds that they're buying up and the notes and bills is going to affect what the interest rates are on those. So they can control where that yield curve sets just by how much they choose to buy. If they see it's going up, starting to invert, they can keep that from happening by just, buying more at whatever end they want to do to manipulate things. So of course they're going to do that. Why wouldn't you do that, rather than let it go out of control? So long as the Fed was buying bonds, I said the yield curve is effectively locked. It's not going to invert. I said, but wait till the Fed starts tightening, because this inflation we're starting to see is going to get out of control. The yield curve is not going to predict it, because the Fed's still in the stimulus mode when it should be stopping. Like I was just saying, how stupid that it didn't when it could see the beginnings of inflation happening, but it's not stopping. It's still doing it. So it's got the yield curve locked until the Fed flips its game and starts tightening, which will be when inflation is out of control. We're not going to see that yield curve change. And of course, that's exactly what happened. Is as soon as the Fed started moving into its tightening thing, we saw the bond yield starting to change quite a bit, and the curve starting to change its form. I said, all that's going to happen after we're already in recession, which it did. It happened, in the early part of 2022, but we were already in a recession in 2022. It started in the first quarter and ran through the second quarter, where we had negative GDP for both of those quarters. It did not get called a recession because the National Bureau of Economic Research that makes those calls looks at two things primarily. It looks at GDP, but it also looks at the labor market, because it figures, just like the Fed, if labor is really tight, the economy must be strong. And I made the argument, the economy is not strong because labor is tight. The economy is strong because the labor is tight because there is no labor. People quit their jobs for various reasons when we had the COVID lockdowns and didn't come back. So what we really have is not a strong economy with a high demand for labor. We have a very low supply in the labor market, making it tight, which is a whole different dynamic than we've probably ever seen in my lifetime. So I said, we are in a recession. Labor is not going to cooperate and show that because it's tight for the wrong reasons. It's not because of a strong economy. So they didn't declare a recession, but we saw it in GDP. It was down for 2 consecutive quarters, and that usually is enough for the MBER to declare recession. I said, this is going to be a double dip recession. It's going to come back up out of it, and then it's going to dive down harder, just like we saw in the 70s, because the Fed's going to, it's going to start tightening. It's going to gain control of inflation, and it's going to lose it again. And now we see that happening. For the last 3 months, inflation has been going down each month. but the Fed says it's not. I mean, excuse me, inflation has been going up, but the Fed says it's been going down each of these quarters. It hasn't. Year on year inflation has been going down. Month on month inflation has gone up each month and each of the last 3 months. And so the Fed looking at year on year inflation, that's kind of, again, a case of an easy bar to cross. You're looking back to a year when inflation was way out of control and saying, well, year on year, here's how much it's changed. It's a lot. It's going to take a long time to get that year on year inflation to start looking worse than it was. So what we need to look at is month on month inflation, because ultimately, if you're going up a tiny bit, the inflation rate is getting higher each month, a tiny bit. Eventually, that's going to add up to year on year inflation that's going out of control again. And that's what we see happening. So,
well, to sum up some of what you're saying, the Fed conjures money out of thin air and buys bonds with that money conjured out of thin air from the Treasury. In effect, one hand lending money to the other hand, in effect. And that enables the rates to stay stable and not rise. But at a certain point, with the tremendous organic deficits that we're running in this totally drunken sailor government, at one point, the bond vigilantes, the bond market, Clinton called them the bond vigilantes, they come out of the woodwork and they say, whoa, 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 whoa. If you want to run these deficits and you're going to continue spending like this, you're putting our loans to you at risk. And therefore, we want a higher return, meaning a higher interest rate, regardless of what the Fed says or does. And doesn't that happen at some point, if not already?
Yeah, we're there. And that gets back to the second part of your question. So the Fed was controlling the yield curve when it was buying all these bonds, and then it stopped refinancing those bonds when they matured. And that puts the government out to have to go to new buyers in order to roll those debts over, because it can't pay them off. So it has to roll them over. And of course, it's expanding its deficit. So it has even more than it has to create for the new money that it needs. So as a result, with the Fed no longer in the picture, that's when the yield curve inverted, because now the bond market is starting to take over the pricing. The Fed let go of the reins. And even regardless of what it says it's going to set for interest rates, by not being in the bond market, it's letting the market control the price. And so at first, as the Fed was, raising interest rates intentionally, the bond market would respond and go, well, if the Fed's raising its rates, we better, get more out of the bonds that we're buying. And then we got to a point where now the government is issuing so much debt that the bond market, having taken control fully back from the Fed, because the Fed has let go of the reins, the bond market is now saying, well, hold it. With these huge deficits you've got already, and all of the additional Bidenomics plans you plan to fund, and the extra money you want to raise, there's a lot of bonds out there to sell. And we gotta start pricing interest up here. You got to start raising the interest rate if you're going to attract enough buyers to buy all that debt, because your debt's starting to look shakier and shakier the more of it you're piling up like this. And so your interest rates start climbing because the market's deciding what it's going to be, and the market's looking at this towering debt that's quivering away up there and saying, look, you got credit agencies that are telling you, guys, this is starting to look a little dicey. They're cutting your credit rating down a little bit, and you just seem out of control. You just keep going on and on with it, and so we want more interest to compensate for that risk. And at that point, you move to where, since the Fed's not in the bond market anymore, mostly, then the bond market itself sets the rates. It wants that money, and it doesn't matter anymore what the Fed does. The Fed can say, well, we're going to raise interest rates, we're going to lower interest rates. Doesn't matter. They're not buying bonds. So the bond market is still going to say, well, you got a whole ton of debt here, US government. We want more money if you're going to attract more buyers in to buy all that debt. And that's what it comes down to, is government has to attract a lot more buyers. So it's got to offer more interest.
And who are these buyers right now, and how do we tell who they are?
Well, boy, I don't know who they all are, but in general terms, I think there's a lot of money. It's good indication there's a lot of money that's flowing from foreign markets to the US, because foreign markets all have their problems. So they're looking for safe havens, and their bonds don't look any better than ours. So there's foreign money that's moving in. And a lot of it, though, is pouring out of the stocks, because stocks are, they're not in good shape. There's a lot of reason to think they've got a lot of room to fall, because if you price them based on the economy, there's no reason for them to be way up there. The economy is sinking. So stocks need to fall to catch up with that. And with bond rates, interest rates going up, that starts to look attractive to stock market investors. So you see these moves out of stocks and into bonds. I relate it to being like an old-fashioned pump handle, where as you raise the interest rates, it gets attractive enough that the stock market then pushes the pump handle down and pumps money from the stock pool over into the bond pool, as they go for those interest rates.
Today is Sunday, the 5th of November. Thursday and Friday, the yields, the interest rates on the bonds went precipitously down. I mean, precipitously.
Yeah.
And of course, when that happened, the dollar index also precipitously dropped. Do you think it's possible that clandestinely or surreptitiously the Fed was in there at their trading desk secretly buying the bond market?
No, I think the Fed was very overtly doing something there, which is that Powell came out with this very dovish statement about how, we're going to hold again on rates. And the FOMC made its decision to not raise rates, and the bond market and the stock market all said, oh, maybe it's all over. Inflation is solved. And Powell even came out with a statement and said, for the last 3 months, we've still seen inflation falling. So we think it might be at a point where we've reached a level of economic tightness where the tightness itself and the bond market itself will do the tightening we need through this bond vigilante aspect that we've talked about. Is now the bond market will take over. Well, in the bond market and the stock market, we're all like, oh man, maybe the Fed's out of the picture. Maybe we can all take a big breath of relief. Maybe inflation is, settling back down. But it was a lie. Maybe it's a horrendous mistake based on what the Fed chooses to look at, but inflation has not been going down. If you look at month-on-month inflation, there are, CPI has been rising. It depends, of course, on what you look at, whether you look at core PCE inflation or core CPI inflation or the broad general picture of inflation. The Fed looks at the number that happens to look the best. And, when it reports inflation is down, everybody takes a big sigh of relief. This is ultimately, I think, going to be bad for Powell's plan, really, because this big sigh of relief that happened is a knee-jerk response. But it means that the market is not as tight. That's going to actually loosen things up more for inflation, which is already rising a little bit. So I don't think in the end this turns out to be good for the Fed's objective of cutting inflation.
And you were able to tell they were lying because their lips were moving.
Mm-hmm. Yeah, that's usually the best sign. Why do the work of figuring it out when you can just that standard?
Now, you said that we have a sinking economy, contrary to what the politicians and the Fed is saying. What are your top tier metrics to show what the economy is actually doing?
Well, the most interesting one this week, which people took as a good sign, was that the labor market did finally start to soften. And I said we're probably reaching that point where it's finally going to start to do what the Fed has wanted to see, and unemployment is starting to turn up. And everybody, taking this sigh of relief that the Fed's done raising interest rates, is living in this delusion that, oh, well, if inflation is, going down on its own, like the Fed says, the battle's over, and maybe we'll get that nice soft landing. But the fact is that the unemployment rate has turned up gradually 1/10 of a point, 2/10 of a point, 3/10 of a point. Well, guess what? 4/10 of a point is just about all unemployment ever turns up before, bam, recession hits and unemployment shoots up like a rocket at that point. I mean, you can watch it. It just goes like this, and then it goes like that. We're right at that inflection point. We're up 3/10 of a point from where that bottom was in the unemployment rate. And wherever that bottom is, once it goes up 4/10 of a point, you're in a recession. Some say 5/10. quibble over little numbers, but we're basically sitting right there where recession starts. It won't be declared until many months later because the NBER wants to see all of the the revisions and stuff that come in before it finally makes its determination of when the recession was. They never determine when it starts at the moment. They determine when it started. So, 6 to 10 months down the line, they'll be determining probably that it started this quarter, certainly next quarter. I think this quarter. Because the other thing I think, one of the things I'm looking at is the Fed is so far off, not the Fed, but the government is so far off in its determination of what inflation is that right now at 4.9% GDP, we're really probably sitting around 1% GDP because we're talking real GDP growth rates when we talk about recessions. And real GDP, you have to subtract inflation out. But if the number you're subtracting out for inflation is way less than what actual inflation is people are paying, then the whole picture gets distorted. Take, for example, one of the things the market was excited about because it thought, oh, this looks like a soft landing, is retail sales came in really strong. They were higher than the inflation rate, which indicated that even though people are, because sales on that metric are measured by dollars. So if the dollar devalues, sales automatically go up only in the sense that it costs more to buy stuff. So it looks like more money is being spent, so there must be more sales. To find out what sales is really happening, you got to look at what real sales numbers are and take inflation out. And if you do that and you still have a positive number of where sales have gone, it indicates consumers are actually buying more, just what inflation is raising prices. However, if the amount you're taking out for inflation is way insufficient, then maybe consumers are actually buying less. You're just not looking at the right amount of inflation. And I would strongly argue that that's the case. One, because housing inflation, even the Fed says, and has said many times, has at least a 6-month lag in the inflation metrics they look at before it starts to show up. Well, we know housing inflation was going down 6 months ago, but in the last 6 months, it's gone way up for existing houses because the market's frozen. And so we've seen prices of housing going back up. Well, that's going to come in down the road in the numbers that get reported. But in what people are experiencing in actual inflation is happening now. It just gets reported with a huge lag. So really, people's spending isn't up. Their inflation that they're experiencing is much higher than what's being reported just for the housing metric. The other thing I would say about that is that the housing metric, the way the government calculates it, is just plain stupid. I mean, it is beyond stupid. And, there are several people who recognize this, but not within the government and not within the Fed. They keep pretending it makes sense. So that number is ridiculous in the first place, in spite of its lag, because how do they determine what the cost is of existing housing is? Their formula is go guess. I mean, that's it. That's what it is. It's go guess. We're going to send out a survey to homeowners and we're going to ask them to guess what their house would rent for if they had to pay rent for it, and we're going to put that down as the cost of housing. What has that got to do with the price of tea in China? Even if homeowners knew what their house would rent for in their market, which they don't, it still would have nothing to do with the price of housing. One, they don't know what the house would rent for. They haven't been in the rental market for 10 years. They're homeowners. What do they know about what rental rates are? They hear what their friend down the road is paying or something, and they make their guesses. And you're asking these people who do nothing more than guess to guess what the current rental rate of their house is. So they're the least qualified people to make that guess because they're not even in the rental market. And then the second thing is, what does the price of rents have to do with what it costs to own a home? I mean, eventually, yeah, they kind of flow together over time, but rents get locked in on rental leases that are typically a year long. So they may lag way behind the housing market. And recently when the housing market's been shooting up again like a rocket, housing can get way up ahead of them before rents start going up because those rents are locked in on 1-year leases. So they're not going to necessarily go up right away as housing prices go up. And two, if the landlord bought his house 10 years ago, what the price of housing does today means nothing in terms of the rent he's got to charge to make a profit. He may have a person in there he likes, so he's slow to raise rents because, this guy's a great tenant. There's so many other factors. So to compare it to rental prices is just beyond stupid as a way of getting a measure of what the true price of housing is. So you've got a metric there that I think is grossly understating what people's actual inflation is that they're experiencing. So no, I don't think they're buying more stuff. I think they're buying less stuff. I'm paying a whole lot more for it. Another metric by which inflation was way off, was medical care. The agency tracking inflation put in a, what was it, a 6%, I think, correction every month, a negative correction, a revision, call it a reconciliation, every month for the entire past year, 6% less every month than what medical insurance costs, in order to reconcile past mistakes they had made. Well, it's fine they want to reconcile past horrendous mistakes they made, but why should we trust them if they're that far off in the first place? But number two, it has nothing to do with real inflation today. So you're doing that to reconcile the past, but it's also in the process totally distorting the present by taking that component of inflation down 6% a month. I think the total they've taken it down is over 36% for the time they've been doing this. That all ended this past month. That reconciliation will not appear in the next report. So expect to see inflation take a jump up when that reconciliation has now finished what they needed to do, and we start seeing what real medical care costs are. But the people out there buying stuff, they weren't experiencing the reconciliation. They were paying the real costs. And so to say the consumer is stronger because they're paying more, no, you're just not paying attention to how much inflation they're really having to deal with. The consumer is not stronger. So no, the economy is not resilient because the consumer is strong. The consumer is pretty much maxed out right now. So that was bogus. And then you look at the jobs numbers where unemployment is turning up. Labor is not the strong thing you think it is. It's right at the cracking point. And like I say, once it goes up about 0.4%, then it just shoots to the moon from there. So you're going to see unemployment starting to go up pretty fast here, I think, in a hurry. It didn't go up before because there were so few workers. So there was no competition. If jobs were going down, it didn't matter. Workers still had plenty of jobs to go to if they got fired, because the job level's way up here. You got workers down here. You got to bring those jobs down quite a bit before finally, when somebody gets fired, boom, he's got to go up and get unemployment because there's nothing to go to. We're maybe now at that point.
Is it possible that by the time people wake up to what's really happening, because one of the things that I see is that most people are kind of like, it's like a psychological operation. During COVID, everybody was brainwashed. You got to be 6 feet apart. They believed anything they were told. Nobody questions anything anymore. The old 1960s adage of question authority, that's out the window. You will obey and you will follow your orders, and that is it. Yeah. So when it finally dawns on people, because I walk in the street, and when I walk in the street, I actually observe everything. I'm constantly watching and studying. And I go past the two competing franchises, which are now the two biggest competing franchises in America. One franchise is space available, and the other one is for rent. And people walk past these signs, and it means nothing to them. They're like Sergeant Schultz, on Hogan's Heroes. I know nothing. I see nothing. Hogan, I will not notice anything. And that's the way they are. They think the economy is great. Meanwhile, every store is going out of business. So what are some of the other metrics besides what you've already mentioned that shows this economy is heading to a comatose state?
Okay. First of all, I'd like to clarify that I'm not as much looking at the econometrics as I am at the foundations underneath it, but we'll come to that, the other economic things. But the big things I see are that the pillars are crumbling. So really, it doesn't matter, even if the economy looks like it's going along pretty good here. If the pillars that hold the whole thing up are crumbling badly, then it's coming down, no matter how it looks up above. Everybody can be walking the streets up here, but the pillars underneath the city that are holding the streets up are crumbling. And that's the bond market, the stock market, and the housing market, and they're all failing badly. Stock market is, okay, it got a bump the last few days, but that's going to be temporary. We're on a new, back on the bear path. The whole thing was a bear market rally, and it wasn't really any higher than other bear market rallies relative to the size of the bear market we're going to be seeing here. So that's crumbling. Clearly, bonds are crumbling, and yeah, it got a boost because of all the stuff the Fed said that sounded like all was well, but those little knee-jerk reactions settle out in a few days and prices start going back to where they were. And then the housing market is crumbling. Yeah, right now it's frozen up. So prices have gone back up, but it's only because nobody's selling because nobody wants to buy at these crazy mortgage rates, crazy in their eyes compared to what they've seen for years and years, right? So they're looking at it as, man, if I sell my existing home and I got to buy another home, the price is way up and the mortgage payment is way up. So the market's frozen over. But at some point that breaks. You can't just stay and not buy and not sell forever. Sooner or later, people jobs move, things happen. You got to buy and sell, and it starts to break up. And when that happens, that's going to be a flush. Those prices aren't going up higher when the market breaks and start to move. They're going down because they're already way high, and interest rates are way high. Nobody can afford those things, so it's going to come crashing down. So you look at those big pillars that are the primary foundations for our economy. I mean, housing's always been a big factor because it employs so many people. There are so many things you buy that go into making a house. I mean, just incredible number of products that when housing goes down, then you see, everything going down with it. So you got that, stocks, bonds, all going down. So the whole, a lowering tide sinks all boats. So the whole economy is going to go down with that. In terms of econometrics, you can look at things like, the latest manufacturing reports show that demand is going way down for manufacturing. Manufacturers saying they're probably going to be laying off people finally. They have been trying to hold on to people, move them sideways to other factories, other positions, because there weren't very many laborers out there, so they wanted to hold on to what they have. But now they're talking about going into layoffs. Consumer confidence is going down. It's starting to erode pretty significantly. The factory numbers already indicate that we're in a recession. If you look at what factories are reporting for what they're putting out, what their demands and their sales are, they're already mostly in a recessionary zone. So we may already be in a recession based on what factories are reporting. Sales are already in a recession. As I said, if you factored out real inflation, sales have gone negative. All you got to do is be realistic about inflation. And it's not hard to look at those inflation numbers, especially with respect to housing, but also with the healthcare baloney, and say, really, inflation is a lot higher than what they're reporting because of those errors. And so if you factored it out, then sales are settling. They're not keeping up ahead of inflation. It's just false inflation reports.
Didn't
So
Obama say that Obamacare would make healthcare costs go down precipitously?
what they made for me was the quality of my healthcare insurance went down precipitously. Cost has gone nothing but up. So yeah, it's baloney. And they promised that you'd be able to keep your old healthcare plan. Then we found out that they intentionally lied about it. Maybe Obama didn't, but the people talking to Obama admitted that they had, lied about it. That they said we have to tell people they can keep their plans if we're going to sell this, and that's what they told the president. That's what he repeated, whether he knew otherwise or not. I didn't keep my plan. It went off the market right away when Obamacare hit. They said, "Well, we can't offer this anymore. It was a nice plan. It's gone." So now I got a worse plan, and my employer pays more for it. So, yeah.
All right, let's shift a little bit to the corporate debt market. What are you seeing there?
Right. So that's another, good one of these econometric things to look at. And there, what we see is that the number of bankruptcies are starting to go up. They're not like extraordinarily high, but defaults on corporate bonds are going up and bankruptcies are going up, and they're too high to be comfortable. I say they're not extraordinarily high, but they're going up into let's say you got the normal zone that's green, you got the yellow zone, orange zone, red zone. We're well into the yellow zone and probably getting close to starting to push into the orange zone, with those bankruptcies as well as defaults that are rising. And the number I saw yesterday was about 14%, a little over 14% of American corporations are zombie corporations now. That means that they cannot keep the lights on without taking out debt to do it. they cannot even pay off their debt. They have to take out debt to service their debt. And so long as interest rates were low, they could roll that over, right? Okay, we got this much, we've issued in bonds. We're going to issue a little bit more now, and we can get that, even though we're junk bond financed here, our bonds are rated as junk, but junk bonds that were selling for 3% interest, or 4% that they were having to offer. And so these companies could refinance at fairly low interest. Well, now they're looking, at much higher rates because they got to beat the government rate on bonds. So if the 10 years at 5, those guys got a price at 7 or 8 or whatever, because clearly they're not, as risk-free as government bonds. So those guys can't refinance. And it's just a question then of when their bonds mature and they have to roll them over, and then that's when everything caves in on. So you can have this company, looks like it's been perking along, it's been in business, it's Bed Bath and Beyond, it's selling stuff, things look fine, you don't know there's a problem, and then all of a sudden there's Bed Bath and Beyond closure sales all over the place. You can have, in other words, lots of companies like that you think of as reputable companies that you like, and then one day they're just rolling up the carpets and locking down the doors. And it happens pretty quickly, because what happened is their bond matured, they couldn't refinance it, suddenly in a couple of months they're in default, and now they're making bankruptcy proceedings, and within 3 to 6 months the doors are closed. So that can happen to a business that you really like and respect, but it wasn't making enough profit to keep the doors open.
When I speak to these Pollyanna attorneys, corporate attorneys, their reaction is, oh, it's not a big deal at all. We'll just restructure everything. It won't make a difference. How do you respond to that?
Well, restructuring is called bankruptcy, right? And that's what Chapter 11 bankruptcy is, restructuring. So what are those idiot attorneys saying? They're saying it doesn't make any difference if those companies don't pay their debt. Well, it makes a difference to somebody. If you're the guy holding the debt, it makes a difference to you. If you're the bank, makes a difference to them. So yeah, maybe the company does restructure, but that happens by defaulting on your debt. It means some people, got kneecapped that were extending you money. They got a big haircut and they got less money back so that you could restructure. You whittled your debts down. The court said, okay, you don't have to pay this and this and this. And then you did, you closed a number of stores, so you laid off a bunch of people. Does it not matter? You close stores. What does that do? You laid off all of those people. That matters to the economy. It may not matter to the dumb attorney, but it matters to the economy. It also matters to that local economy, because maybe that business was a big one, like Sears or Penny's or somebody like that, and they shut down a store. Well, that was an anchor store in a mall. Now the whole mall is doing less. And all of a sudden, some of the little businesses in the mall, the more boutique-like stores, are like, we don't have enough foot traffic here anymore. And you start seeing boards, doing your walkabout that you're talking about. You start seeing boards going up on the windows. I did the same thing. I walked through the mall looking for what's closed down, just to see how things are going. You start seeing more of those, wallpapered windows that don't show anything inside because the business is out. And that just creates a spiral where the next business right next to it now has less business. There's just less reason for people to go to the mall. So does the restructuring not matter? Well, it matters when you close your store, and then that closes down a mall, or at least makes other stores hurt more. It matters to the people that go unemployed. It matters to the people who extended you credit, who have to take a haircut. So it matters all over the place. But yeah, maybe that one business keeps going, but it closed down a lot of stores to do it. It's going here, but it's not going there. Restructuring is it shut down in some places. It terminated some employees to get its costs down. And it, people took haircuts on the loans they had extended.
And how do you see? I have a theory that this time you're going to see, unlike when they shut down the country with the COVID pandemic, and you saw all these, waiters and waitresses get fired and businesses closed. Is it possible that this time the white collar worker is going to get excised?
We've already seen some of that. Right now, some people are referring to this as the rich session rather than the recession, because people are taking the hit are more predominantly to the white collar side. That's where the cuts have been happening. There's been such a shortage in the labor pool for the blue collar workers that they haven't been taking cuts. They've been actually getting raises. As we've seen with the United Auto Workers and other union strikes, the lack of competition has given them the strength finally to get better wages that have been withheld from them for a long time, because The white collar, and let's call it the diamond collar, the diamond pin workers, the executives have been making more and more and more money for years and years, and using all of the company's profits to give bigger dividends and to do stock buybacks, which all feeds the rich. And the blue collar guys just sat right here and gone nowhere for 40 years, you know, just stayed locked in there, adjusted for inflation. He's basically gone nowhere. And finally, the unions have had some more power, and those guys have started saying, no, you're going to give us a bigger piece of pie. Now, of course, the richer people on the other side have said, well, then that's going to force prices up. Well, it only does if you don't take it out of your dividends and out of your stock buybacks. You're the greedy one saying we deserve to make 20% returns every year forever. So yeah, if you're going to keep hanging on to that, then prices are going to keep going up. If you just shared a little more of the pie, prices wouldn't go up at all. So I put the blame on the greedy ones that think they deserve forever 20% gains, and that's in my opinion ludicrous. They're now having to share some of it with the blue collar workers. And so the rich are starting to feel some of that because they can't pass all those prices on. The consumer, as I said, is already maxed out and buying less. And Target's reporting that real sales are actually down in unit numbers. That was another one of those metrics that confirmed what I've been thinking and saying, which is that sales were only up because the dollar was down, and it's measured in dollars. The dollar's buying power was down, that is, not its exchange rate. And so, but Target CEO came out and said, no, not only, are dollar sales going down actually, but unit sales are going way down. And that's really what counts if you're going to measure sales. The government doesn't measure that because they don't know everybody's inventory that precisely, but Target does. And they look at units sold and they're like, no, units sold this year are really going down badly. So sales are going down. So that's another one of those metrics you can look at it to say it's not the rosy picture or the stable economy that's being presented. And that's forcing some of those executives or at least upper management and mid management people to start taking some cuts because the businesses can't pass on all those costs. Consumers are just saying, forget it, we're buying less stuff. So
speaking of consumer, let's segue into consumer debt. What kind of shape is consumer debt in?
Well, defaults are up some. Kind of again, we're like into the yellow zone, I suppose. But the use of credit cards is way up. Now, interestingly, long-term credit has gone down, the amount that's in use. Not, or maybe I shouldn't say long-term credit, but the kind of credit longer term, like you use to buy a refrigerator or something, where maybe you get some in-store credit. You want to buy this refrigerator, you can't afford it, and the company says, well, hey, we can finance this $2,500 refrigerator for you, and you take out a store plan. Those kinds of things have gone down and been paid off because the consumer is now saying, we really can't be affording right now to go out and buy refrigerators. The old one's running. You can probably keep running for 5 more years. Let's live with it. So that aspect of consumer credit has gone down. At the same time, consumer credit card use has gone up. And so that's a towering pile of debt right now. And I don't know how much more it can go up before basically they're tapped out. But their savings rate has gone way, way down to abysmal levels of savings. That's not how much money they have in savings. That's how much they're putting away. But that's a pretty good indication if they can't put away any savings that things have gotten real tight. And if credit is going up, that, okay, their spending must be coming on credit, not cash, because they're not putting away money anymore and they're taking out more credit card debt. And how much longer can they afford to do that when the cost of that credit card debt is rising so quickly too? As long as you roll it over every month to pay it off, you're okay. But once it starts getting up there, it gets harder and harder to pay it off each month too. So
and on top of that, they're resurrecting the student loan payments.
On top of that, so that's going to put a lot more pressure on too. So I think we're going to see this pressure build quickly, right? The consumer's basically maxed out, and the point thing is you can go and go and go, and things are going okay. But when you reach that point where things maxed out, they can flip fast. That could be a true tipping point where things fall over because they just can't do it anymore. So they're like, okay, well, I'm not going to eat beef. I'm going to eat chicken. It's cheaper. You start making all those types of adjustments. And the government, looks at it. The Fed even looked at it and said, well, it's not like cost is getting much more because consumers are rolling over to eating chicken. I'm like, that's a cost. It's costing me the experience of enjoying my beef or salmon or whatever it was I was eating that cost more. I'm paying that cost now because I live with a lifestyle where chicken is the highest thing I can afford to put on the table. And And that's just an example, but we do that in a lot of products where, they're saying people are rolling back in quality. Okay, well, that's a cost. That's a cost of consumer feels and experiences. So consumer sentiment's going down, and that means they're tightening their belts. And that's why we have the rich session where the guys at the top can't easily pass along these wage increases because the consumer says, no, I'm not buying it. I need a diet anyway. I'll eat less. I'm not going to buy the refrigerator because, we can live 5 years on the one we got. That kind of stuff.
Well, it reminds me of my father when color TVs came out. Every time my mother wanted him to buy a color TV, he said, it's not perfected yet.
That's exactly what my dad said. He said, why would you want to look at those colors? They look crazy. Wait
20,
until they look
20
real.
years went by, not perfected yet.
Same thing in our family. Finally got good enough. Okay, we'll buy one.
Right. Well, our time is winding down. And we kind of ended on you were talking about that it goes up and up until they realize what's happening. And it reminded me of the Wile E. Coyote cartoon,
Yeah,
where
yeah.
he keeps going and then he realizes, uh-oh, there's
We're past the
nothing
cliff.
underneath him, and it goes right down.
Yeah.
And economists call it the Minsky moment, named after the economist Hyman Minsky. Things that can't continue to go on won't.
Won't. That's right.
And that's kind of where we are. So, David, tell our listeners and viewers how they can keep track of your writings, how to subscribe to you. And for those of you out there who know me, I don't patronize and genuflect to anyone. I say exactly what I think, whether you like it or not. And I can tell you that David is one of the best writers on this subject that we've been discussing. And I know a lot of good ones. Not the majority, because the majority stink. But the good ones, David is at the top. And for those of you who actually read, which is a diminishing group, tell us, David, how to get your work.
Well, thanks, Bob. Go to thedailydoom.com and you'll see an editorial there posted every weekday, even for free. And on Mondays, I let people see the headlines that I gather for free too, so they get a sense of it. But for those who decide to become paid subscribers, what they'll get is not just the editorial, but every weekday they get my summation, my list of, I think, the most important headlines to read from my fairly wide reading of the news each morning, and during the day I compile it during the day, so that they can keep a sense of the most important economic stories out there. And then my editorial basically takes out of those and highlights what's most significant, what you should notice that's not being noticed, that kind of thing, to help you keep perspective on where this thing is going. So thedailydoom.com.
And you also publish these, what you call daily dives.
Yeah.
Deep into the bowels of the earth on these subjects.
Yeah, for the paid subscribers during the weekend, like I'm just finishing one up now, I'll put together, usually it's a more analytical approach with more graphs and the kind of econometric data you're talking about, what it is shows the economy sinking, and I'll lay all those out and try to give a real clear synopsis of what it means, because sometimes people get lost in the numbers. So I try to put it in fairly layman terms of what this represents that you're seeing. Pick out the main story of the week and focus on that.
All right. Well, thank you for your intelligence, your integrity, and your clear thinking. It's very rare. You have a good day.
Thank you, Bob.
Okay.
Bye.
Take care.